the tax rate would be zero if everyone had to write that check at the end of the year, but it's not, but they don't. I wrote a couple checks. One year I wrote a check that would have like sustained a family of five, like 5 families of 5 per year, right? Like I could have supported 5 other families, middle-class families. So it was a significant amount of money. I could have bought a house with it, right? Like just cash. So yeah, so it was a significant amount of money. And I was like, okay, my accountant's been chirping in my ear, like, hey, have you thought about real estate as a possible like tax solution, et cetera? And so I started to dig a little bit more into it. And and then I started buying real estate. And then probably my 2 biggest wins were the past 2 years. I went from 6-figure checks to the IRS to last year I got a refund. So, and I made more money than I've ever made. So it's a little crazy.
So you made more money than you ever made and then the US government paid you.
Yeah.
Cody Littlewood, tell me about the macro economy. What are your thoughts?
I don't know. I think we're recession May 13th. I don't know.
Recession May 13th. Man, okay, so shout out to Pasha because I texted Pasha and I said, what's a question I can ask Cody that'll throw him off? And he goes, ask him about the macro U.S. economy and what are his thoughts?
Oh, man. Oh, so he wants me to go on a rant. I feel like we're just like asleep at the wheel and no one knows what the hell is going to go on. And no one seems to have a solution. Like the question I always ask people is, how can our weighted average maturities of the U.S. debt be like 60 months out there? And we're currently in this interest rate environment that if it continues, and if the treasury like slide the 10-year, for example, slides to like 4 or 5%, our interest level expenses, like we go into a debt spiral. We're on this path where our interest rate expenses are going to grow and grow and grow to the point where we have to take out more and more debt to service the interest rate expenses. Like, for example, if interest rates stay where they are today for the next 5 years, I think CBO projects the interest expense of the US government will be greater than like Medicare and defense spending. And if it continues on or it increases even like a little bit more from here for like over 10 years, it'll be more than Social Security. So we'll literally be spending more and more money on our interest expense. And it's just like a company, right? If you load up a company or a property with so much debt, it can't service its interest with its income, and it has to take out more debt to service the previous debt.
It's a debt spiral.
It's a debt spiral. And like, I keep asking that question and no one can give me a good answer. So so that's probably what he meant. That'll throw me off because no one can give me an answer. No one can tell me, like, the best answer I've got is that, we're just going to have to grow our way out of it. Which
nobody knows what it means. It's provocative. It gets the people going.
Yeah. So I feel like that when I say these things, but I legitimately, no one can really spell out the math besides either A, we move into a lower interest rate environment because that's the only way we can structurally handle the debt load, or B, we grow our way out of it. And we don't have the demographics to be able to grow like what we were able to do in like the 60s, 70s, 80s. So I don't know.
And this, ladies and gentlemen, has been your 5-minute market update for the Action Academy podcast. 5-star rating and a review. All right, Cody, you started a big old company, made a boatload of money, realized you hated paying taxes, and started investing in real estate. Pretty traditional path. I like how you did it, man. Capitalism 101, pass it on. Talk about the story of how your company founded. And then I want to get into you getting hit with that first tax bill, and you're like, something's got to change here.
Oh, yeah, sure. I used to work in software. I still own the software company, but I sit on the board now. We have a CEO and executive management team, et cetera. And they do awesome and do a really good job of running the company on a day-to-day basis. But I originally founded the company. I'd been freelancing as like a contractor, like a 1099 contractor. I was an engineer by more or less trade. And I was like focused on leading software development projects for a large Fortune 500. And I was a 1099 contractor for this one company that I used to work for as a W-2. I transitioned to be a 1099 because, long story short, I was living in Argentina. They recruited me out of Argentina. I went and lived in Kingsport, Tennessee, which is like the middle of nowhere. And I wasn't very happy there. But I had really cool mentors at that company. I really probably don't give enough credit to some of the senior leaders there that were like, this kid's really talented. And they're like, we want to hold on to you, but you can't be a W-2 if you go live in Argentina if you leave, but we'll keep you as a 1099. And so they set that up. I guess that was my first like taste of not working for somebody else, of kind of doing my own thing. And then I started thinking, like, I read the 4-Hour Work Week, and I don't believe a lot of the things in that book, but like it opened my mind into, wait a minute, I'm doing all this work as a 1099 contractor, but I could leverage other people to do this work, right? And I could leverage their skills and their time, and that's a form of leverage. And that's like really what woke me up in that book. Partly was leveraging how to leverage others and achieve scale. And then also just, I guess, this just general idea of entrepreneurship and not being tied to a specific location, which was really attractive to me. So I started pitching these other companies, and it accidentally worked. So like the first company I pitched was like, yeah, that's awesome. We want that service. We're going to send you a contract. What was the name of your company again? And I was like, oh shit. And like, I didn't have a name of a company or anything. I hadn't incorporated. And so I just used my online handle, which at the time was CodeLit, was like my first and my last name. And I was like, it's CodeLit Inc. And luckily the name was free. And I secured a domain name and email address really quickly and called a lawyer. And by a week from when they'd send over the contract and we negotiated terms, I just incorporated and basically signed the contract, and they sent a check the next day. And I was off to the races and had to go hire people and figure out how I was going to deliver on this contract.
What's the size of the company today?
We do about 10 million in revenue, maybe 2.5 million in EBITDA.
Nice. What's the head count?
50 some odd people, 50 to 60 people. We grew. It's funny. I wish I knew then everything that I know now. But for the longest time, we built the company based on my kind of network and my connections. And then over the past couple of years, we put in a formal sales team, and that's really like a really formal enterprise sales team. And that has really like rocket shipped the company.
Let's talk about that a little bit before we talk about your exodus. Sorry, ladies and gentlemen, we are forcing you to learn entrepreneurship because I want all of you to be entrepreneurs who happen to invest in real estate instead of real estate investors that happen to dabble in entrepreneurship. So talk a little bit about that process, man, because what you said, man, I wish I knew what I know now when I was starting that company. Say more.
Oh, I mean, that is a really deep subject of the quantity of things I didn't know then that I know now. But I would just say I heavily believed. So, and this is actually true of my real estate investments now, where we're building a holistic firm instead of just being deal guys and going and doing real estate deals. We're building like a holistic kind of private equity firm to support that. But I didn't realize the importance in the software business. I didn't realize the importance of sales. And for me, it was like Field of Dreams. If you build it, they will come.
Engineer product guy.
Yeah. I was an engineer. That was like what I knew. I like to write code. I like to, and it worked. Like we survived as a lifestyle company doing like a few $3-4 million of revenue or so, provided great lifestyle for me, my family, and the employees that worked there. But I just didn't know how important it was to build a repeatable pipeline of business. And so many times, this actually was part of what led me into real estate, as so many times we'd be so focused on just providing awesome services. And so the customers would stay with us for a really long time. But then if they bounced, we didn't have this consistent pipeline. And sometimes it wasn't our fault. You used to work in corporate America. So,
in sales,
a change of leadership in sales, right? But you know how it is, like a change of leadership, decision maker changes, your champion leaves, whatever it is, right?
The budget changes. Yeah,
exactly. So stuff out of your control can happen, and as good of a services you're providing, your contracts can change, and all of a sudden we'd be without a contract because we'd have massive customer concentration and no sales pipeline. And it would be up to me to go rustle up some more business. And that's just not a sustainable business. And so that was like the big wake up call in our business as I exited the business. Actually, we probably wouldn't be there if it wasn't for me exiting the business, honestly, a few years ago, because we'd probably still rely on my network and me being able to hustle up new business instead of a formalized sales program.
So you got out of your own way and you let your business grow to where it deserved to be. Is that correct?
Yeah, I think so. Yeah, absolutely. I was not serving it by working in the business. So.
Yeah, you're definitely in a pod with Cody Bugan because we had the same conversation, man. Walk me through, how did that feel? So walk people through an org chart so that they have an understanding of the gravity of what you did, and then talk through the actuality of what you did, because you gave up your role of your own company. You stepped away from CEO and took a chairman position. So what does that
Sure.
mean on paper for people that are unfamiliar with kind of org chart? And then walk through what it meant to you philosophically, battling that ego part of that.
Yeah, it's a good question. I probably still battle a little bit of the ego part, if I'm being honest. But the org chart at the time, I had my second in command, the COO at the time, and we have a CTO and a couple other key kind of executive leaders. And at the time, I stepped back. Part of what stepping back meant was was really a change in like compensation structure for a lot of the leadership. And so going through that exercise, and I didn't do a good enough job of it in the beginning. I've done a much better job of it recently. And so we pay probably a considerable amount more than if I were still active in the company to have the right type of people in place to support the firm and to be incentivized and to treat it like they own the firm, right? We gave away a bunch of equity. We're actually in the process of finalizing the RSU program right now. But essentially to incentivize, to have the right types of leaders, but to properly incentivize them to treat it like it is their own business. And then a big thing that I wanted to fix was I had a lot of, I always like to think of it as baby birds coming to mama bird with their mouth open. That's like they wanted I did well, so give me a raise. And I wanted to instill the mindset of, if you crush it, you don't need to come to me for a raise, because your bonus structure, your profit share, et cetera, is going to speak for itself. So stop coming to me for a raise, you go crush it, and the market will give you a raise. So the kind of law of compensation, so to speak, right? You provide value to the world will provide value back to you. And
Sure.
kind of to instill that more entrepreneurial like mindset in the business, we put in a board and we help set the goals of management, hold management accountable, and support them in hopefully their execution.
Sweet. And then so now you have somebody else running your company. How did that transition go for you?
For us, I guess it was pretty easy because I put in the second in command. And so he'd seen the business from a long time. But I think probably the hardest part was not letting go fast enough and then providing support as they needed it. So I probably stayed too involved for too long. And honestly, one of the biggest things that I learned was, as long as somebody can, I don't want to say blame's not the right word, but as long as somebody can count on you or blame you, or you're involved enough that it's not falling on their shoulders, because if there's multiple people accountable, then no one's accountable, right? And I probably didn't get out soon enough to just leave the team accountable for their actions and for their decisions. And that doesn't mean not provide them support, but I probably stayed involved for too long and they kept counting on me for too long. When I really see that the more I got away from it and really it was just on them, the more independent they became.
Got it. Yeah, when I was talking to Cody, the topic that came up was going from chaos to corporate, to where you get to a certain point where you do need the guys to come in that have the ties on, that are like, okay, like here's how we build up an HR department. Here's how we build out these systems and these processes. And it's just, we hate it to our core because that's what we were escaping.
Totally. Yeah.
And it's difficult. It's difficult to do that. So we resist it until it comes time, and then somebody else has to be the one to execute that. So yeah, I love that transition, man. So you were making a bunch of money, and we just left Lake Tahoe for Go Abundance, and we were talking to a bunch of other guys that made a bunch of money. And one of them was on stage, and he was talking about his company and his pharmacies and everything. And he was saying how his main regrets in his business were, two of his main regrets were not utilizing lines of credit against his business to invest in more stuff and to invest in his business. And then the second was not utilizing real estate to take advantage of the tax cuts and just getting hit with a massive tax bill every year and just paying it and just grinning and bearing it. So talk us through that transition of you realizing, hey, there's another way to not have to pay all these taxes.
Yeah, it was, I don't have as many regrets because it only took a couple times. And I've said this on another show and I'll say it here, But if every American had to write a check at the end of the year, like entrepreneurs do, instead of like most Americans, it comes out of their W-2. So they don't really see it, right? They see it like they're like, oh, that hurts. I wish that was going in my pocket. But you don't actually see it hit your bank account. But when it's sitting in your bank account all year and then you write that one single big check, I was going to say April 15th, but let's be honest, none of us file till October 15th anyways.
I'm filing so many extensions, it's going to be head spinning.
Yeah. We always get our K1s out for our investors on March 15th, but my accountant knows. Yeah, we know you can wait. So anyways, yeah, the tax rate would be 0 if everyone had to write that check at the end of the year, but it's not. But they don't. I wrote a couple checks. One year I wrote a check that would have like sustained a family of 5, like 5 families of 5 per year, right? Like I could have supported 5 other families, middle-class families. So it was a significant amount of money. I could have bought a house with it, right? Like just cash. So yeah, so it was a significant amount of money. And I was like, okay, my accountant's been chirping in my ear, like, hey, have you thought about real estate as a possible like tax solution, et cetera? And so I started to dig a little bit more into it. And and then I started buying real estate. And then probably my 2 biggest wins were the past 2 years. I went from 6-figure checks to the IRS to last year I got a refund, and I made more money than I've ever made. So it's a little crazy.
So you made more money than you ever made, and then the U.S. government paid you.
Yeah, to be fair, I did have to file an amendment, and I ended up owing $5,000. Yeah, because they missed a K1. I know it sucked, but so that'd be such a better story if I could like just leave it there. But no, I did end up owing $5,000. But I mean it was nothing compared to what I used to do, and it's obviously through the power of now I'm an active real estate professional, and easily because I only spend 4 hours every quarter on my other business, and everything else is towards a real estate private equity firm and the power of depreciation. And I know a lot of guys that have the same thing, and maybe they aren't real estate professionals, but their wife is one. Their wife's a real estate agent or something like that, and they've set it up like that. And so they benefit from that as well. Bonus depreciation's also been obviously a huge play, and that's starting to go away. They're starting to fade that out, but still a massive amount of benefits from investing in real estate on the tax side.
So walk us through you going from writing these big old checks that were making you nauseous to starting to invest in your real estate. So
sure,
how did it begin, and walk us up to where you are today?
Yeah, so I started with a single family flip. It was a disaster. I'm still dealing with it today, surprisingly. Yeah, so it's a long story, but it turned into a nightmare. We got a good price on it. But then we got in and we realized that the walls, this is only Miami story, something that happens. It was a house in Little Haiti in Miami. And this is like only something that happens here. We learned that several of the walls were trash. They were framed with trash stuffed in the walls and then stuccoed over. It was crazy. I've never.
That's the most Little Haiti thing I've ever heard.
Yeah, it was so crazy. I've never seen anything like that in my life. So we ended up rebuilding the whole thing. We were supposed to spend like $100,000 on it. We ended up spending $200,000 on it. And then we got a violation for doing work without a permit, even though we were like making the place way nicer. We were doing work without permit. So we are still to this day in the process of finalizing. This is years and years later, still in the process of finalizing working with the city to get that cleaned up and get that damn thing sold because I no longer want it. But long story short, we did that one. Then we did a duplex that was super successful. And then we did another house. And then we did like a triplex. And then I was making pretty good money from my business. By the way, I think it would be really hard to get started building wealth in real estate as an investor,
really?
Just as an investor. I think so, right? Like if you're just going to be an active investor, I think it takes a significant amount of time to build it up because you don't get those big equity hits. Whereas if you build it in a business or an active business, or maybe it's an active business that is real estate, like flipping. I think flipping's a business. I don't think it's investing. Or if you're doing some sort of crazy development play, or if you're like, I don't know, you're figuring out you're doing some sort of like commercial, I don't know. You have to figure out a way to get like these big equity hits to really be able to deploy enough capital into real estate that the yields start to provide the cash flow that will actually cover your lifestyle. Or you have to have a business that enables you to do that. And I had a business. Like, I think it'd be really hard to do it. And I know some people have, and it's amazing.
I agree with you. And that's exactly that plays into exactly the quote I just said before, where in GoBundance, a lot of the elite level and champions, I feel like that's one of the key differentiators is like kind of the 7-figure mark is people that were good investors, right? And you got some good properties under your belt and you're able to buy them really low and then they're high and you got equity and you've got appreciation and all that. But I feel like the champion level is more so the guys that started the businesses and they own the entire operation and the entire process. And so now you're not only talking about the appreciation, but now you're talking about EBITDA and all that.
Yep. Yeah. I think it's just easier to your return on invested capital and return on invested time with operating businesses is higher. It's higher headache. It's greater risk than housing, for example. But I do believe that I said that because I had a significant amount of money that I had to, I was working partly because of the tax thing, but also partly because I'd seen all the ups and downs of my operating business. It was so risky, or it did just have big ebbs and flows of capital and influx and then slow times and a big influx and slow times. I was like, okay, I want to build like a more of a steady cash flow base for my family. Then like by the third duplex, I was like, okay, this is going to take a really long time doing this. Like
$200 a pop. Yeah.
Yeah. I'm trying to replace like a few $100,000 of income a year. And it's going to take me, I don't know, like 120 of these things or something. I don't know what it was, but I just remember thinking like, this is going really slow. And so we did our first, we found a deal. It was a 22 unit deal in Palm Beach. And I started, we basically got it under contract. It was it was a little bit of a weird deal. There's just some things that were weird about it. It was like, it wasn't a single building. It was like one big building. And then it was all on the same plot of land, but this weird layout. It wasn't easy to just go get like small balance Fannie debt. So there's like a few non-conforming things about it. And it was a little small, had crazy low rents though. And we just saw the upside. We looked at the comps and we're like, I think at the time we thought we needed to get, I'll have to go back and look at the underwriting, but I think we needed to get from $600 rents and we wanted to hit 900. And if we hit 900, it was going to be gravy. But we couldn't get the financing to work. And it was this older lady, and she owned so much real estate. And she'd owned this forever. Her base was crazy low. And so we were like, would you consider seller financing the deal? And so she agreed. She seller financed at 3.5% interest only for 3 years. And then another 2 years that start to amortize. So 5 years total. And with that deal, we started doing, we came in, we brought in some professional management. Shout out to Carlos Rivera, who's here in Miami. You probably know him, and he's crushing it with that deal. But we'd underwritten like $850 rents. We also caught all of the past few years of rents. And now that thing's doing like $1,400 rents, and it's just ridiculous. The cash on cash returns are like, we haven't even pulled our equity out. So we haven't even done a cash out refi, which always boosts your cash on cash returns. I'm sure you've seen that, right? Yeah. Your cash on cash returns are like 10%, but then you do a cash out refi and all of a sudden you have half the cash in. So you're getting 25% returns.
Or it's infinite ROI.
Yeah, exactly. Or even a partial cash out refinance where you're getting significant higher returns. We have not done any refinance. So we have all of our own equity still in it. I think we have $500,000 in it, and it's doing 35% cash on cash returns, which is ridiculous just from the value add and like holding on to it. So I think it's not, now we do 150, 200 unit deals. So our next bigger deal, was like a first $6 million deal. We found this deal. This one was also a really cool one. We found this deal. It was downtown Macon, Georgia. It was this really cool building that had been totally restored, but it was way too big. It was finally, I found a deal that I couldn't do with my own capital. And guy in my pod, Michael Poole, he'd been doing a bunch of really big deals. And this was a Fannie debt. Had never done Fannie before. And we found it, and on the purchase, it was a 7 cap. So we were buying a 7 cap, and it was downtown Class A. All of its tenants are like doctors, lawyers, etc. So we're like, there's just no way to lose. And we bought that deal. We were going to buy that deal, but first I didn't have the money to do that deal. We had to put down like $2 million. Second off, I also didn't have the experience to qualify for the Fannie debt. And Michael's in my pod. He's, listen, bring me in. He's one, I think I can help you figure out how do you raise for this. And then second, I've done a bunch of Fannie and Freddie deals. And so anyways, long story short, he helped me believe in myself. And we went to a bunch of other people that we knew and said, hey, we found this deal. It seems like a crazy good deal. And we ended up being able to buy it. It's been an amazing deal. I think we've had some soft offers float. I think we bought it for 6.3 and we haven't done any real value, like no major value add. We've ridden the rents up with loss to lease, etc. But that's a big deal, and it's doing double digit cash on cash. I think low double digit cash on cash, and we've gotten several offers at 8.5, 9 million, which would be like a, I don't know, 2.5x equity bump in the course of three years or something. Anyways, so that was me and Michael, and then another partner. And I guess long story short, me and Michael looked at it. We're like, he was doing a bunch of deals in Chicagoland, but he wanted to do more deals in the Southeast. I wanted to keep doing bigger deals. It was a good partnership. He was really great at acquisitions. He had an awesome pipeline and systems that he built out, really great at capital markets and placing debt, and had just understood. He's ex JP Morgan guy, so he understood how to talk with bankers. I operated companies before and really understood the asset management side. And then also I like talking to people and I like helping people. And I was pretty good at on the equity side. And so we basically looked at it. We're like,
not how.
Yeah. Who, not how. Yeah. Yeah. So it was like a marriage. It was a marriage of our skills. And long story short, we were just like, do we want to be deal guys? Do we want to just like, when we see a good deal, maybe we'll do it together, maybe we won't. But I felt like we were taking outside capital, and he felt like as well, we wanted to build like the infrastructure. And so we came together and we said, let's build a proper firm, proper private equity firm, and hire the asset managers and the analysts and everything else that we need to support the deals going forward. And that's what we've been up to. And then we keep doing bigger and bigger deals. And now we buy 150 to 200 unit, $20 million deals.
Heck yeah, man. So where's the portfolio at right now? And then where are you trying to take it?
Yeah, between the two of us, we own 1,500 doors. It's a few $100 million in assets under management. Just the Southeast portfolio that he and I work on, it's probably like 125, 150 million assets under management. Our goal is well over in the billions of dollars of assets under management. So we've recently hired two of our kind of key lieutenants. If you think about doing deals, there's three legs to the deals, right? There's your capital stack, there's your operations, right? And there's your acquisitions. So you got to find great deals. You got to be able to finance them, and you got to be able to operate them super well, right? Too many people ignore the operations, right? Everyone thinks it's all, yeah. Everyone loves to be a deal junkie, but the operations, you're only buying a deal for 60 days, and then you're operating a deal for 10 years. So like, you tell me what you think is more important. Michael would probably say acquisitions. I'd probably say operations. But
that's
so we've hired
exactly.
So we've hired kind of two of our lieutenants, our VP of acquisitions, VP of asset management. We recruited them from much bigger firms than ours. And we're looking for a VP of investor relations and capital formations. And we have several analysts that we've hired. And I think we're building a really good team. I know so much more about company building this time than I did the first time. Yeah. So I'm doing a much better job at it this time.
What do you think are the main differences between the first and the second?
The first one, I would wait until we were bursting at the seams to hire. And now I hire, even though it's not profitable to the firm, we'll outlay the capital, me and Michael personally, not like the deals, right? But like us personally on the firm side, because you probably understand how real estate works, but like you have the deals and those are all entities and they have their deal related costs. And then we have our firm and we have our firm related costs, and that we get paid asset management fees, and our asset management fees and some of the acquisition fees go to keeping the lights on at the firm. So we outlay capital in advance and hire great people before we need them. And so Cody Bugan, we were just talking about him. He likes to say escape and then scale, not scale then escape.
No, I like that. Yeah, and then that helps you scale it even better, right?
Yeah, if you can do it, if you have, yeah, that is part of the, that's part of the benefit of also having capital now. Before, I don't know if I had the money, but I think take a bet on yourself, right? Take a chance on yourself. If you believe in the business, if you believe in the business model, make those hires before you're bursting at the seams. Make those hires and then grow into those hires will help you grow instead of waiting until you're bursting at the seams to hire.
I love it. So what things do you need to change to get to that next level and that next goal that you have of the billions?
A little bit of it's just time and market. It's consistent time and market. Land the planes we have up in the air, execute on the value add deals that we're doing right now, operate well the stabilized deals. And just keep acquiring good deals, but without pressure. Like last year, for example, we were hoping to do 4 or 5 deals and we did 2 because we just couldn't make the numbers work. We were too far apart. The bid-ask spread was too far. That's part of it, to grow out our investor base, broaden the scope. We've placed a lot of family office money, a lot of institutional money, but we are just starting to broaden out our kind of more high net worth individual base. And so that's a big part of it. And just honestly, like I said, a lot of it's just, I really believe in the power of compounding. Stay hyper focused. We have a very specific strategy. Don't get distracted by shiny objects and go try to do a development project or something, and just keep doing great deals in the box that we know well.
I love it, brother. Where can people find you and where can people find out more about the firm?
Yeah, we have a podcast called Your Next 10 Million, and we actually got to have you on, Brian. I don't know if Posh is scheduled. He's like the booking champ. But so you can find us on Apple Podcasts. You can also find out more about our firm at investwithcarbon.com. Nice.
All right, ladies and gentlemen, you heard it here first. This has been Brian and Cody with the Action Academy podcast, signing off.